welcome to another episode of Macro Monday. My name's James Brodie. I'm Head of Learning and Development here at Onyx Capital Group.
I'm James Todd, Head of Performance here at Onyx Commodities.
I'm Will Cunliffe, a Research Analyst here at Onyx Capital Group.
In this week's episode, we'll look at US tech stocks. We'll see how long they can keep going higher. We'll look at both the bullish and the bearish cases.
Employment and ISM data came out in the US last week, and these continued to show worrying signs for the US economy.
We'll also see how Trump has intensified his tariff rhetoric, imposing new export taxes, and we'll also have a look at the inflationary landscape in China.
So we didn't have an episode last week, so let's briefly look at the US employment data, which came out much worse than expected across the board. US job growth slowed sharply in July, the weakest hiring since COVID. Employees added just 73,000 jobs for the month. But what's more concerning is the 3-month hiring average stands at just 35,000 people. As you can see from the chart here, hiring is pretty much in free fall now. And every time it's been that low, we've been heading to recession and it's looking pretty weak.
Yeah, I mean, and also the big concerning factor there is the massive downward revision, 260,000 jobs, I think, revised. You just can't seemingly trust the data. I mean, the BLS has always kind of had a pretty poor history of revisions, but this is almost another level.
Yeah, it's a really hefty downgrade, obviously, and this, for context, it's one of the things that Trump had often criticised with Biden and his administration whenever there was, non-farm payrolls coming out or employment data that seemed to be positive. It did seem to be revised down a lot of the time. So, Trump was understandably criticising, the data and also the Biden administration for that. But now that it's come back to sort of, now that he's got a bit of egg on his face, he's, clearly unhappy with it because it's exceedingly weak data. He's also threatening to replace everyone that coming out.
Well, he has fired the head of the BLS, which then brings in concerns about how accurate will the data be going forward. Can we trust it?
Exactly. And, the Fed during COVID, for example, they just stopped looking at the payrolls numbers, even though, half of their dual mandate is full employment.
So looking at other data as well, long-term unemployment climbed to 1.83 million, and we're seeing weekly continuing claims actually breaking new highs as well.
Yes.
I think it's also worth noting that in the context of analysis of the US economy over the past year or so, one of the few things that you've been able to sort of hold on to in terms of indicators in a high inflation environment, etc., this positive, the employment section was not that bad in the US.
No.
Unemployment was historically in a very low percentile. Whereas this is really, this is beyond.
And I mean, it still is. Unemployment at 4.2%. That's seemingly not very concerning, but that's all to do with labour market participation. And we've seen a huge kind of exodus from the labour force, which has been kind of supporting that unemployment statistic at the lower levels. Do I still think that 4.2% will concern the Fed? I still don't, even with payrolls printing this soft. But the trend almost certainly will.
Interesting. The revisions actually come from government data because government data comes with a lag. So it's all the layoffs we've seen there that produce this. But the 2-year we saw fell basically 20 basis points. Do you think the Fed would have cut? Because we had the meeting the week before if they'd seen this data. Because now we have, 58 basis points of cuts priced by year end? And JP Morgan calling for 3 cuts at the next 3 meetings.
I mean, it's kind of given me flashbacks to last September where Fed was like, no, we're not cutting, come out, do 50 basis points and then have to pause again. So I think they'll be keen to avoid overextending their easing cycle to avoid what happened last year.
But then if we move on to the ISM data, US manufacturing PMI fell to 48 in July, and services PMI was really weak. Actually came in at 50.1. 51.5 was the forecast. That was much weaker. But if you drill down, employment at 46.4, new orders at 50.3, 1 point lower than forecast. It's much weaker, but then the standout really, prices paid has surged to 69.9.
Yeah.
It's absolute worst case scenario for the Fed.
Stagflation. I also think, 80% of the US economy is services. So you can have a downturn in manufacturing, and we have seen that basically since COVID, especially in the PMIs. And that's obviously not fantastic, especially for Trump, who wants to really stimulate the industrial sector. But the services have remained pretty resilient, and we saw a lot of pent-up demand unwind post-COVID, which really stimulated that service sector. To see that start to tail off now will be concerning for policymakers in the US.
Yeah, and if you look at the chart here, this is the 2-year yield. Put a long-term chart so you can see back to COVID. You can't really see, or you can just see the last few days how aggressively it sold off after that payroll data. But you can see we're just sort of 25 points away from a long-term support. If that breaks, then it's going to be, bond move is going to be huge.
Yeah.
And what's holding it up at the moment? I think it's the fact that the Fed haven't cut yet. We need to see a bit more weaker data. And I think the other thing that's holding it up is equities. We'll come to that in a minute. But equities are, the Nasdaq just made a new all-time high. S&P is just off all-time highs. Equities seem oblivious to the risks.
I think it's also issuance. I think we've had a lot of debt issuance, especially at the front. They're starting to kind of move that issuance, front load it a little bit at the Treasury, and they have been kind of, those auctions have been less performant than auctions previously. So that will kind of, keep yields a little bit elevated, but.
I guess we see a lot this week. We have a lot of data coming out. We'll highlight that later, but CPI on Tuesday is a big one. If we don't get the feared CPI that the tariffs are, everyone's fearing, then that will be the green light, I guess, for cuts and maybe yields lower. We had CPI out this morning, didn't we, from China? PPI down 0.2% month on month, but down 3.6% year on year. It's deteriorating, but CPI is not as bad.
Yeah, I mean, CPI was flat, so it's still come off a little bit from last month at 0.1%, printed flat today. But that was better than expectations of a 0.1% contraction. So I think there's a few different factors weighing on the statistic there. One was food. Food was very soft. And also you have quite a strong base effect going on as well. So, I mean, it's more of that kind of, that sort of diversion in the Chinese economy, where you have massive overcapacity on the productive side. And that consumer is starting to kind of ramp up a little bit. I'm starting to see a little bit of strength in the consumer, but still a long way to go.
And equities are picking up actually in China, which isn't the economy. We mentioned that before with the US, but there's a sign of confidence.
Yeah, it's risk appetite. Yeah. The Chinese household is willing to take on risk again after 4 or 5 years of being very, very risk averse.
And if we look at the tariffs, the trade wars, more tariffs imposed last week, 15% on Japan, 25% on India, 100% on tariffs on chips and semiconductors. But probably the biggest news this morning is that Nvidia and AMD are going to pay 15% of their sales revenues to China, to the US government.
Yeah, so I think regarding these sort of particularly the chip stocks, and you had the Taiwanese firm as well, a lot of these companies, Nvidia included, when the tariffs were announced, stocks were up on the day. In fact, like it really, Nvidia, I suppose it makes sense, but especially foreign produced stocks were up on the day, basically because it became clear that Trump was willing to sign deals on the side. We saw it in iPhone as well, when Apple committed a further $100 million to the US economy and developing, software and hardware as well in the US. Trump just sort of allows them special exemptions. So I think this is basically the view that the market has taken, which is that, despite these headlines saying like, yeah, we're sticking to our policy, aren't we amazing? In reality, he's just looking for any genuflection from companies such as this. And in reality, they can just sort of tokenly say, oh yeah, we're going to be collaborating with you. Aren't you wonderful, Mr. President Trump? And in reality, things carry on somewhat as normal.
Yep. I put the chart here of the dollar, a very long-term chart, but what we're not seeing anymore is the dollar going down on all this tariff news. In fact, the dollar's bounced in the last couple of weeks. You can see there's a perfect trend line. Is the whole market short of the dollar? We've seen it's one of the biggest fund positions.
Yes.
Has that run out of steam now?
Yeah, I mean, I think it, is clearly a very crowded position, so you're going to see some pullback there, or you're going to see a limit to how far it can extend. But it is striking, actually, the difference between this recent set of tariffs and the first set of tariffs. We've not seen anywhere near as significant capital flight from the US. I think markets, to an extent, it's more the same. It's more fatigue in the market. I think they're as James, you mentioned, the chances of Trump trying to get deals now are greater than the markets expected after the Liberation Day tariffs. So I think that's also capping downside to the dollar.
Yeah, I kind of feel like we do break lower here, at least sort of off that upward trend line. And the point you make of funds is quite interesting because, funds basically, they were quite short equities over sort of the earlier period of the year. I think overall they've got longer equities, things like that start to perform. And if they, have called a short dollar position and they're, making a bit on that, they already have capital perhaps that they can put in from equities. You might see a reloading of short positions from some funds here. And particularly in the backdrop of, barriers to trade, etc. I think it does make sense for the dollar to come off. So I wouldn't be surprised if we see the dollar coming off, which I suppose is bad for any holiday makers in the US coming over to Europe for the summer.
But again, you're seeing yields trend lower, which that should also
weaken the dollar.
Yep. Exactly. So.
But if we look at other data, we're getting a lot of weak data across the board. If we look at Eurozone here, weaker data, surprisingly, construction PMI shrank to 44.7. In France, it contracted to 39.7, the lowest since September. France is looking really weak. New passenger car registrations in France fell 7.7% year on year. German industrial production fell 1.9% month on month. A lot of weak data. I'll run out quickly with it. Germany's trade surplus shrank to 14.9 billion, smallest since October 2024. Weak data across the board. The only bit of strength really is in Spain. They've had 6 months of consecutive lower unemployment.
Yeah, I mean, Spain continues to kind of be the bright spot of Europe. We've seen that France has been a particularly stark deterioration, I think. Again, a lot of it is to do with that kind of service sector, the hospitality, the tourism, and Spain's really kind of jumped on that. But who knows? I mean, that's very cyclical. So it'll be interesting to see how that plays out. The concern, I think, going forward will be what transpires in Russia, Ukraine. If they can reach any sort of deal there, I don't think they will, but if they can, then that could potentially alleviate some worries in terms of can Europe get natural gas from Russia again?
But it's an interesting point, that, because I guess my question would be, if there were to be a ceasefire in Russia and Ukraine and you get assurances on cheaper energy prices, which you would have thought would be good for German manufacturing, all of these, that should be a real shot in the arm. Haven't these guys just committed to purchase a ton of energy from the US? So I don't know, maybe that was just very opportunistic by Trump, but the ballpark figures cited were absolutely enormous. So say Russia, Ukraine were to do this, are they going to stand on their commitment to the US, or are they just going to realistically purchase?
Well, it's interesting because I think, so as soon as India and China came out and said, no, we're still going to buy Russian, we're buying market, so whatever's cheapest we're going to buy, then Europe also came out and said, the agreement that we reached is not binding. It was just words at the end of the day. So I think we're kind of getting this kind of collective backlash against Trump's actions at the moment. So
what I find interesting as well with the European data weakening is we've had all this stimulus announced from Germany 5 or 6 months ago, and now we're suddenly seeing the data weaken, I'd expect it to be going the other way. It's got to be concerning. Chart I have here, this is a weekly chart, Euro yen. Looks like we had a big run higher, but it looks like a clear double top. It looks on the weekly charts like it's reversed. I think we'll see more cuts priced by the ECB. I think over the next year we have over 100 points priced now by the Fed, but 28 points priced by the ECB. And I expect we'll see more cuts there.
Yeah, for sure. I think, the market largely thought the easing cycle in Europe had come to an end and we were getting close to terminal. I think the recent prints will definitely motivate more easing there. The one thing they'll be looking out for as well is guarding the euro and making sure that doesn't appreciate too strongly, because that's clearly weighed on the German trade balance.
If you look at the UK data, weak data last week, but then we had a surprising Bank of England meeting. So the data, manufacturing PMI in the UK's revised down to 48.0, again, contraction. And manufacturers continue to complain about declining export demand, labour market conditionings weakening, and firms citing weaker domestic demand. But despite all that, also weak passenger car registrations down 5% year on year. But the Bank of England came out and surprised. They had a revote, didn't they? They cut 25 basis points, but more hawkish than expected.
Yeah, and I think that's quite interesting, obviously in the context of a relatively high inflation environment. The fact that, they're deciding to cut despite inflation testing the upper limits and exceeding it at points probably indicates how worried they are about, the underlying situation in the UK. As the car data there said, I think we have a demand issue and yet we have high inflation. We have structural production issues and yet we have high inflation. So they need to do something. I think basically the UK is, I'll save the strong language, but the UK is not in a good position at all at the moment.
Yeah, the chart here is a daily chart of sterling against the US dollar. You can see it bounced last week from a clear double bottom, but to me it looks like it's in a downtrend now. That looks like it's setting up for head and shoulders, and again, the key support line you can see very clearly there. It looks like it will retest that and break lower. So on to equities. We have US equities. The Nasdaq on the weekend or Friday night just marginally made a new all-time high. S&P 500 is just below all-time high. But what we've got now is it's really basically concentrated in a few number of stocks, a magnificent 7 amongst others. But the top 10 stocks now in the S&P account for 40% of the market cap. It's incredibly narrow, the breadth. Nvidia now accounts for over 8% of the S&P 500, which is the highest weighting for any single stock in the index's history. Another key point, though, to highlight the weak breadth, less than half the stocks in the S&P 500 are above their 20-day moving average. Forward PE, and the bullish side of it, forward PE profit margins have just made new all-time highs. So these companies, there's profits out there, but we see it's sort of concentrated the stock strength in a small number of stocks. You can see from the chart here, the concentration of the top 10 stocks. And if we move on to the next slide, you can see the recent trend of Nvidia, which is a massive uptrend. I mean, retail are just chasing it, aren't they? It's different to AMD and GameStop because it is such a profitable company. But I mean, is this getting like a bubble?
Yes. I just think, it's obviously it's a very crowded trade and the momentum is upwards. And so, anyone taking a short position over the past few months will have been wiped out a bit. But it just seems as though there's a lot of dumb money going into this stuff. Whatever your opinions may be, it doesn't seem like a rational price-earnings ratio. Maybe not even the worst price-earnings ratio of the stocks that, we'll go on to talk about some more. But yeah, I just see it as being, it's got a real competitive advantage at the moment, and understandably people are jumping on that. Everyone is so head in the clouds and in love with this idea of AI and etc. But I do think it's overvalued, hugely overvalued.
And as we keep saying, it is an uptrend, so you can't fight it. If you want to go short, if you're long, happy days, have a tight stop.
Yeah.
If you want to go short, wait.
Yeah.
Hardest thing to do is, in that case, is sitting on your hands. And as we mentioned before, funds have been going short tech stocks in the S&P, and retail have been buying, and retail have been the winners.
Yeah, I mean, Michael Burry was pretty aggressively short Nvidia, so I hope,
I put options,
Yeah.
If we look at the chart of the S&P, you can see here, actually what's interesting, we didn't make a new high. We're obviously looking to test it, but the 3 or 4 times we've been above the sort of the white line I've put there. The white line is the highest closing high we've had. But 3 or 4 days after that, we opened higher and closed lower. So the market, we're seeing selling coming in at these levels, but the critical level now, the S&P needs to close above 6,390. If it does, then actually you'll see more buying coming in. One thing with technical analysis, it becomes self-fulfilling. And again, if we move on, forward PE ratios are now the highest in 20 years for the IT sector and the MSCI World Index. You can see from here, equities are expensive. We can say that, that's pretty conclusive, but they're still trending higher. And moving on to the Nasdaq chart, you can see here, it just made a new all-time high on Friday, but only 50% of stocks in the Nasdaq Composite Index are actually above their 50-day moving average. So again, it's concentrated in a small number of stocks. But again, we really need to see a good open and close above that all-time high. If we get a break below, then for sure we'd see some profit taking.
Yeah, it sounds like the success is, very similarly concentrated in a smaller batch and selected batch here. So
exactly what we saw in 2000. I don't want to great similarities because I'm not saying it's a bubble and it's going to crash. It's trending up, but the Cisco systems of the world. And what makes it interesting actually is we come into a period where it's seasonality, its volatility picks up. You can see from the chart here, the VIX, the volatility index that trades on the CBOE exchange in Chicago. Typically September, October, November, volatility spikes in this period. So be warned. And Brent was a lot weaker last week.
Yeah, I suppose the major headline was the Russia-Ukraine edging towards peace talks, which is, it's a headline that we've heard so many times, and the fact that the market still does react so violently is pretty interesting, I suppose. But
yeah, definitely. I think there's also a lot of interesting kind of developments in terms of the Middle Eastern grades as well. So today we got Saudi allocations to China, and they were a lot softer than August allocations. So September barrels going over is looking at about 43 million as opposed to 51 the month prior. OSPs were hiked pretty aggressively above what structure had implied. So the Saudi light into Asia was up $1. And I think, that's going to have an impact on China's ability, but also appetite for strategic stock building, which has been a huge conduit for a lot of the surplus out of OPEC over the past few months. And that's been what's really been maintaining. I think analysts have been particularly surprised about how bearish the balances have looked, but how strong the curve has been. And a lot of that has been explained by China just soaking up the barrel. So if we're starting to see them moderate their strategic purchases, then it makes sense that we might see a bit more of a bearish move to the downside.
And while on commodities, onto gold, which although it's actually selling off marginally this morning, it's targeting the key 3,430 level. You can see there. I think it's a matter of time before it breaks. Another key gold factor or bullish story now is that Trump's nominating Steve Mirren to join the Federal Reserve. This is very bullish for gold. He devised the Mar-a-Lago Accord, which calls for lower rates and a cheaper dollar. I think it's a matter of time till that breaks. Again, it's been a long sideways consolidation. We had a huge move higher from the original 2080 level. Going sideways for nearly 6 months now, but when that breaks, again, you'll see breaking new highs, you'll see more money coming in.
It's been tested so many times at this this top level, hasn't it? So, yeah, would hope it breaks up at some point. But.
And what's interesting with that is Bank of America's global research came out over the weekend. Their fund manager surveys, and fund managers are actually underweight gold and Bitcoin. 75% of fund managers have no Bitcoin and 41% have no allocation to gold, which really surprised me, particularly the gold. Bitcoin is breaking higher today. It looks like we're going to have a new all-time high close. Ethereum was also up another 7.5% over the weekend. So the crypto fans are happy this morning.
Yeah, the party rolls on.
And onto Palantir, a stock. We're talking about high PE ratios. You can see here, Palantir PE ratio over 600. Yeah. Compared to, you can see Cisco Systems there during the Nasdaq peak. I mean, we ask, is this a bubble? You can see the chart. Next one is the chart of Palantir. It's going straight up, but this is clearly retail now chasing it. When you get these blow-off moves to the upside, at some point you get an equally aggressive move to the downside. But now it's going up. So if you're long, hold with tight stops. I think the key is tight stops. But how long can these keep going up?
Yeah, it's an interesting one as well, where I'd flag, European weapons manufacturing and defense companies have been doing, particularly well over the past 12 months or so. I think revenues are being estimated at sort of 3 times what they are during peace times. And obviously we're in a period of quite a lot of international conflict and headline grabbing international conflict. So a company like Palantir, who, the US military is basically, will be the majority of their revenue. They are going to be doing better in a sector that is doing better over this time. So it's not totally irrational to me that they do well, and particularly when their pitch deck includes AI so much. And
of course, I mean that's their business model.
Exactly.
I also think with Palantir, like you're completely right. A huge majority of their revenue will be contracts with the US government or other governments worldwide, but they are focusing a lot on diversifying those revenue streams as well. For example, they got a contract with the NHS doing a bunch of AI implementation there. So they are kind of not just market leaders in the defense tech sector, but AI more broadly. And it makes sense that they are on the higher valued side. 620 is a mental PE. That is huge.
It's quite interesting that you mentioned this with the NHS though as well, because I think when you have a stock that is performing so well, it naturally grabs a lot of headlines. Yeah. Yes, headlines saying, oh, it needs to come off, but also some headlines saying, oh, actually we're doing, this thing. Yeah. And if you're an institution like the NHS where they come under fire all the time, if they're worried about having a second rate set of infrastructures put in, etc., they might actually want that rubber stamp thing. A government can look at these things and the civil service can think, okay, well, we are getting the buzz company of the sort of very a la mode company coming in and doing these things. So in the same way that upward momentum in tradecraft can support upward momentum in terms of market hysteria and publicity, upward momentum can also lead to future revenues and upward prices.
I think one thing you don't get in other countries though is the retail fervor to buy these stocks, which I think you get these blow-off moves to the upside.
Of course.
But would you buy that at these levels? If you had a choice, be long or short at this level, which would you go with? And you had to hold it for 6 months.
I'd probably be long. 6 months.
Yeah. Why not go long? I mean, if you want to be bearish dollar, bearish Bitcoin, bearish everything, you've got to be long something. So
I agree. The trend is up for now.
Yeah.
One I would prefer to be long of, and it's actually not a company that I really strongly believe in actually, but Tesla, you can see the chart here. We've had a sideways consolidation and it's breaking higher. So if there's one that I would look to be going long of at these levels. I certainly wouldn't be going long a fresh long of Palantir, but Tesla with a breakout like this technically looks pretty good to me. So what's priced for the OIS markets? The Fed is the OIS overnight index swap is now pricing, the market's pricing 111 basis points of cuts over the next 12 months, 58 basis points by year end. I mentioned earlier that JP Morgan are going for 3 cuts. They're going for 75 points. ECB just actually 17 points of cuts. I think that one's a bit skinny, to be honest. Bank of England, 48. New Zealand, 51. RBA, we have a meeting this week. The market's fully expecting 25 basis points cut. Bank of Japan, the market's pricing 35 basis points of hikes. Again, it's another reason why the yen trade, the carry trade, we saw that blow out earlier this year. We might start to see that move lower. We looked at the euro-yen chart, but if we start to see a hike materialise from the Bank of Japan, then that trade, that crowded trade could get unwound quite aggressively. And we have a busy week with data. On Tuesday, we have the OPEC report, US CPI, probably the biggest piece of data this week. RBA rate decision, also have UK unemployment and German ZEW confidence. Wednesday, German inflation. Thursday, we have US PPI, Aussie employment. And then Friday, a big one, US retail sales and Michigan consumer sentiment. But then Chinese retail sales, industrial production and employment. So we get some good Chinese data this week. What do you expect this week? More volatility?
Yes. More volatility. I think we're still going to be really subject to some back and forths from Trump and, you know, the tariff fallout, etc., any reneging that will come. So I could see a good amount of, you know, maybe over the next month, 6 weeks, some consolidation in a lot of asset classes. But over the next week, I could see, good amount of volatility, perhaps to the downside.
Any closing thoughts, Will?
Yeah, I mean, I think it's going to be an interesting week. I think there's lots of potential headlines that could come out. But I do think the market is kind of a little bit numb to all of it all. To anything that Trump says, it seems the market doesn't want to read into it too deeply, knowing that he might change his mind next week. So yeah, there's of course opportunity for increased volatility, but I think also we're in a quiet period at the moment. The market feels like it wants to trade with low volatility at least.
And the one other key event, of course, this side of the screen on Saturday, Toddy's doing a full Ironman Kalmar in Sweden. So good luck on that one.
Yeah, absolutely. I think after that it'll be easier to stick to the macro. But yeah, no, it should be good fun.
Excellent. Thank you for joining us this week. Have a good week. Hopefully the market treats you well, and we'll see you next Monday. Thank you very much.
Thank you.
Thank you.